us and talk about, but they're happening. Atul Mehra is with us, fund manager at Motilal Oswal Asset Management Company. Atul, good afternoon. Good to have you here with us. You know, if you think about it, and maybe you disagree, but I was just thinking that either you've got to be very short term, or you've got to be not very long term, but you've got to be long term. This in between period has kind of disappeared. That I don't know. I mean, do you feel that way? Because things are priced quite finely. In the very near term, of course, things will move based on this or that, earnings or otherwise. Otherwise, things are kind of priced for FY27 and beyond. What's your sense, Atul?
Yeah, hi Prashant. Hi, good afternoon. Yes, to some extent, I would agree. Yes, that given that say stocks are priced in terms of taking into account FY27 earnings and so on. So what you're actually seeing is reactions on either side, on the positive side or on the negative side. So the delta in terms of surprises, either positive or negative, is what is getting reflected in terms of day-to-day prices. Otherwise, stocks broadly are just consolidating per se. So to that extent, yeah, it's right that stocks are going broadly nowhere, and only the surprises are getting in terms of priced on a day-to-day basis.
Atul, you look at the IPO space, lots of new listings recently. Anything that you purchased in your portfolio?
We've had a number of names added to our portfolio, and even this week, like we would have about 3 new IPOs open up. So there's a lot of activity in the primary market, just not just IPOs, even in QIP in terms of a lot of other deals, etc. So actually, if you look at it, what is really happening is the secondary markets are kind of consolidating in this very narrow range, and a lot of incremental activity is on the deal market side, and that is where I think most of the incremental attention, energy, money is going towards. So even last week, like for example, you saw a $3 billion QIP. You had a number of blocks in the last 1 or 2 months, $1 billion plus blocks. So what you're seeing is secondary markets broadly consolidating, and a lot of deals getting basically in terms of activated and dealt on a day-to-day basis.
Atul, with the disclosure, can you share where you've participated in a big way?
We would avoid any stock-specific name. But fair to assume that we have been active in a number of IPOs over the last 3 months, and even the pipeline in the next 3 to 6 months is a very large pipeline. Number of names that are lined up to hit the markets.
Interesting. Speaking of IPOs, today's listing has done so well. Anthem Biosciences stocks holding on to a gain of 28%. So yeah, I mean, there is a fair amount of interest for specific stories, specific companies, I suppose. Quite evident. Overall, by the way, just reiterating, the market is trying to make a bit of a move now. The Nifty is trying to inch towards the 25,100 mark. It has another half an hour left. Let's see if it can get there. It's the first meaningful move in otherwise what's been a completely ranging session. So let's see if this takes us anywhere further up. Atul, hi. So, tell us what you've been doing largely in the last couple of weeks, 2-3 months since the market got into a range. The range is now almost a month old. I mean, what is the preference? Mid caps, large caps, in terms of sectors? How are you primed for the earnings season?
So I think in the last few months, it's primarily been a little bit more stock specific because the index has gone nowhere. And incrementally, what we've seen is in terms of names which are in terms of on the small and mid side, especially, they are having sharper moves in terms of appreciation. So incrementally at the margin, we've looked at more stock specific individual names, some of the newer names that we've added to the portfolio. And that is where I think the delta is. Broadly, if you look at it from a sectoral perspective, like we continue to, in the fund that I run, remain overweight on financials and telecom. Those have been the key overweight sectors. And other than that, there's been broadly most of the other sectors have been more or less in terms of aligned. Metals, we continue to remain underweight as a sector. So that is the sector positioning at this point in time.
Metals not finding favor with you, Atul. It's a tricky one, and maybe you'll believe that there is money to be made in other sectors. Let's talk about the banking space, because today you have the Nifty Bank that's roaring away. It's up 700 points technically as well. It took support at 50 DMA. It's crossed the 20 DMA. That's great. But how are you positioning yourself on the banks? Because the larger banking names, they're doing extremely well today, while some of these mid-sized banks that actually, or smaller-sized banks that trade at a sharp valuation discount, they're getting pummeled actually. But their weight on the Nifty Bank is so less that no one's really talking about it. What do you like? Do you go for the value names, or do you believe you'd rather stick to the large cap names?
Sure. So I think in terms of, if you look at the results that have come by so far, the large set of banks, large private banks especially, they have been very, very strong in terms of performance, and they've been beat in terms of NII, as well as asset quality has been quite stable. What you're seeing in the mid-sized banks is some level of issue on the asset quality side, especially like we've seen in case of a lot of commercial vehicle exposures and so on. Those have been the ones where we've seen some level of asset quality in terms of negative surprise that is coming about, and which is what is getting reflected in some of the NBFCs as well as the small finance bank space. So it is in that sense on the mid side, it's a little bit of a mixed bag on the asset quality side, which is why the stocks are perhaps reacting on the negative side. Large banks, they continue to remain very robust. And so far in terms of our positioning, portfolio positioning in the fund I run, so it's primarily towards the large banks and not too many of the mid financials. So some of the names we own are more on the HFC side, where we believe that with the interest rate cut that is perhaps further getting in terms of accentuated, you'll see that some of the HFCs which have a large fixed rate book, they tend to benefit disproportionately because your lending side is fixed while your liability gets repriced lower as you have in terms of the interest rate cycle playing about. So there we believe there could be some beneficiaries that could come about. But other than that, very, very selective on the mid financials.
Thank you, Atul, for joining in. He's also overweight telecom, and one of the stocks,